Hi guys, this is Ravi again from the Nifty BN channel. Today we are going to learn a strategy which is popular among both traders and investors known as covered call. A covered call is an options strategy used to generate income from the stock or stocks you already have in your portfolio, assuming you have shares equivalent to at least one lot size of the stock or stocks. For example, if you wish to deploy the strategy on a stock you own, say Reliance Industries Limited, you should have at least 500 shares of RIL in your portfolio. Similarly, if you wish to do it on HDFC, you should have at least 250 shares of HDFC in your portfolio. The covered call option strategy can also be applied to a futures contract of the same underlying asset. That is, it can be done on, say, a monthly futures contract of Reliance Industries Limited. In fact, a futures contract is less expensive when compared to owning the shares of the underlying asset, but it is always bound by an expiry date. The strategy involves selling an at the money or out of the money call option against either a futures contract or stock of the same underlying asset. Now let's take a look at some pros and cons of this strategy. The advantages are it reduces the cost of purchase as every time you sell the call option, you collect a premium, thereby reducing the initial cost of the stock or the futures contract. It increases chances of making a profit as you make profit when the stock price stays the same, moves higher or a little lower. The only time you lose is when the stock price moves lower significantly. The disadvantages are it offers no protection to the downside. That is, you are exposed to substantial downside risk should the stock price of the underlying plunge. There are instances when the stock price shrunk to as low as zero. It caps the upside profit potential. The strike price of the sold call decides the amount of profit you can make should the stock price of the underlying take off. Now, let's see how this can be done with an example on RIL May futures, which is currently trading at 1218.5, and RIL May 1220 call, which is trading at 109.85. The covered call strategy can then be executed as follows. Sell one 1220 call and buy one futures. Both are of the May expiry. Now, a close look at the risk reward graph reveals that while the maximum profit at expiry is capped at 55,675, the maximum loss at expiry is unlimited. Let's study how the maximum loss, maximum profit, and the break-even point are calculated. As the strategy offers no protection to the downside, the maximum loss at expiry is theoretically unlimited. The maximum profit at expiry, though, can be calculated as follows. Maximum profit is equal to premium received when the call is sold plus gain in the futures contract capped at the sold call strike price. In our case, it would be 109.85 into 500, which is the lot size, plus 1220 minus 1218.5 into 500, which comes to about 55,675. The break even is equal to futures contract price minus sold call option price, which comes to about 1109. As this is not a risk defined strategy, let's look at some adjustments we can make use of to reduce the maximum loss at expiry. One popular adjustment is to buy to close the existing sold call, which is 2200 call in our case, and sell to open another call, either of the same month or of the next month, at or below the break-even price, which in our case is 1109 to collect more premium. The adjustment should be done when only about 10% premium is left in the sold call option price, that is 10% of 109.85, which translates to about 11. Another adjustment is to convert the trade to a collar to provide downside protection. This would cap the loss, but at the same time reduces the maximum profit that can be achieved at expiry. This is done by using some of the premium collected while selling the at the money or out of the money call to purchase a lower priced out of the money put and thereby reduce the maximum loss at expiry. We at the Nifty BN channel recommend the collar strategy over the cover call strategy as it protects you against any unexpected movement in the stock's price. We would post another video in the near future where we would talk about the collar strategy in detail. The last and final adjustment is actually to do nothing, as this strategy is mostly done on stocks already in your portfolio, and as you have already collected some premium by selling a call which you would not have collected had you not sold it. You can either wait for the stock to rebound or continue selling calls and collect premium each month to reduce the initial cost. There are instances when successful traders and investors recovered the entire initial cost of purchasing a stock by selling out of the money calls each month. Thank you for watching. Please post any questions you have on this video in the comment section.